All right, good morning, everyone in business law. I'm going to do a quick review of Chapter 33, Ownership of Corporations. How do you own a corporation? A lot of people that run corporations often also have an ownership interest in the corporation, but not necessarily so. And those that own the corporation very often have only limited control over, and very limited at that, over how the corporation is actually run or managed. And that is through the power of voting, and only those who are members of a class called common shareholders have the power to vote for the board of directors, which controls the management company, hires the president and the vice president and different management teams, and controls the nature of how the business is going to go. And they're only really subject to what we call the fiduciary obligation of the business judgment rule. I'm surprised the book doesn't talk about more. Many of you are business majors, so you might know about the business judgment rule. But generally speaking, you can't sue the corporation if you're the owner, you're a shareholder, and you think the business is really kind of screwing up. They're subject to the business judgment rule as long as they're exercising reasonable business practices, even though it may have been a failure in terms of the process and in techniques that they've been using, as long as on its face it was a reasonable attempt to enhance the profitability of the corporation. There's very little you can do as a shareholder. You sell your shares. You can go to the annual meeting and gripe, but generally your only power is done through the voting of your common shares. And that's only if you own common shares as opposed to preferred shares. I'll get to that in a second. So ownership, general rules. Ownership of in a stock corporation represented by shares of stock. A share is not the physical piece of paper. You can have a piece of paper and say, "Oh, here's my share of stock." Well, what if you lost that in a fire? Does that mean you've lost your share of ownership? No, share of ownership means how much you own, and that's reflected on the corporate records of the book. And if you're going through a brokerage, the brokerage house will record the nature of your level of ownership of any given corporation. The share is the legal title. The document, the certificate itself, is evidence of that legal title. And so say I had a share, it would say on it my ability to convey that share to another party by endorsement and often delivery, like a negotiable instrument. I shouldn't say that, but similar to a negotiable instrument. Or it might limit my ability to convey that share, where I might have to write a first refusal to the corporation to buy, or maybe other members of the corporation. The articles of incorporation and the issuance of the stock certificate will actually give us a lot of limitations potentially on how that's actually conveyed. If it's a publicly traded corporation, well, then we know we can just put the matter up through a brokerage onto the stock market, and it goes to the highest bidder. So it's represented by shares of stock. And again, stock is not the piece of paper. That's the stock certificate. The stock certificate's lost. You can have a new reissuance. And if you buy a share of stock in a smaller corporation or even in a publicly traded corporation and it's evidenced by that certificate, you want to contact the corporation to have a new certificate of stock ownership recorded with the corporation and issued to you, so there's no ambivalence about actually who owns those shares. You can become an owner by purchase, by subscription, by gift, by inheritance. A corporation may be validly formed even if though it doesn't authorize all the shares. An example of that is the corporation comes in existence, they have the authority to sell 100,000 shares, they only sell 50,000 shares, you own 25,000 shares of the 50,000 position, you owe 50% of that corporation. And the board of directors can decide to issue further shares later, and we'll get to this rule, I think, in a different chapter, and if it's not, we'll cover it now. If you own 50% of the shares and there's a new public offering, you have a right to buy a proportional amount of shares of the new company. Otherwise, you'd be liquidated, no longer be the majority shareholder, and maintain control. I think it's common sense. Again, the stock certificate is representing your ownership. You lose it, it gets burned, it gets lost, it gets stolen. You still own the share. You just need to get a reissued certificate. But if you sell that share by signing and endorsing the document and issuing it, trading for money or property, whatever you do, or gifting it to somebody else, they should contact the corporation to have a new certificate issued and to register it on their books so that future profits and or notices of annual meetings and things like that get sent to you, not to the previous owner. The most common form of stock ownership, ironically, is a common stock. Common stock is It's presumptively, if you have a question, I don't know, is this preferred stock? What kind of stock is it? It's going to be considered common stock if it's ambivalent. Common shareholders usually their only power to run the corporation is through voting to the board of directors. The board of directors runs the gambit. And who are the board of directors? How many are there? It's all incorporated in the articles of incorporation that were filed at the state that issued the corporate charter. Corporate charter is the permission from the government to run the corporation. They're entitled to dividends when a dividend is declared. Now, sometimes, okay, you own some shares in a company. Let's assume it's publicly traded. You're here, they're doing great, and they don't issue any dividends, or they issue only a very small amount of dividends. You really have no right to complain unless they're doing it on purpose to somehow injure the stockholders, which is very rare. They may be withholding distribution through dividends because they want to reinvest in the company or buy other related companies to enhance its market share going down the road. So you have very little control. But once the board of directors does declare a cash dividend, it cannot be revoked for any reason. Very important. So they're entitled to dividends when declared in a share of assets upon dissolution. I should talk about that more often. Sometimes a corporation isn't making money very well, and it might ultimately dissolve, but it still could have a great deal of value because it might own a lot of real estate or machinery or things like that. And there might be a lot of value in the dissolution of it. And that's another reason why common shares of stock have value beyond dividends. And some stocks don't pay any dividends at all. It's a growth dividend. I don't believe Amazon pays any dividends. So your goal of making money with them is that as the profitability of the corporation goes up, the value of your individual stock goes up. How do you make money? You sell shares of stock that you bought at a lower price previously. Preferred stock. This is a fascinating area. Preferred stock is you get first in line for a certain proportional share of profits when they are distributed. Corporations sometimes sell this to attract money. They just need investors. And boy, why would I invest in your? I'll tell you what, we'll sell you preferred shares. Preferred shares might, and it's going to be outlined specifically on the contract of purchase and on the certificate of stock itself. It might be 5%, and it can either be participating or non-participating. It's presumptively non-participating unless it says otherwise. And what participating means is if it's 5% non-participating, which most likely would be, most are non-participating, that means if there's any corporate profits that's going to be given out in dividend, I get the first 5% with the other people who have preferred shares. So if there's only enough money to go to the preferred shares, well, I'm in line first, I get it, I'm fat and happy with my 5%. The common shareholders may not get anything that year. But what do I give up for that right? Well, one is I might have paid a lot more for that preferred share, but I also give up the right to vote for the board of directors. Almost no control at all. It's a pure investment. That's all it is. If it's participating, not only will I get that first 5% of profits distributed to me, but I'll also get the same amount as the common shareholders. So if there's a very profitable year, I'll get the first 5, but then I'll get, say there's another 10% distributed to common shareholders, I'll get that as well. Most preferred stock is non-participatory. But if it is, it can be also not only for profits, dividends, it also could be distribution of assets upon liquidation. I think the book does a really nice job on this. Preferred as to assets, preferred as to stock, non-cumulative, and most of it is non-cumulative. Oh, you can have cumulative too. This is pretty interesting. So say I got 5% cumulative. For the next 2 years, there's no profit. I don't get any dividend, but neither do the common shareholders. But in the third year, there's a bonanza year. I will not, before any common shareholder gets any dividend, I will get the 5% from year 1, the 5% from year 2, and now the 5% from year 3 because it was cumulative over each year. It's a rarer form, but it's good that you know about it because think about it. You might say, well, I recognize the nature of the business. There might be some years I won't get any, but it's kind of banking it. You will get it later on when there's a banner year, and that's before any of the common shareholders get their share of profits through dividends. So you could have cumulative preferred participating stock. So, there's a lot of different types of mechanisms by which you can get first in line multiple times through preferred stock. It's good to know about it. Par value stock, I don't get too hung up on this, but par value is when stocks initially issued to subscribers at the corporation's inception, it has a par value written on the share that's given to you, and actually on the stock certificate. That's the amount of money that the initial subscribers pay. It could be $2, could be $1, could be $100. It doesn't mean it's going to be backed up when it's sold the second time. How are shares of stock sold secondarily? Based upon the value that you can get in the market. So par value doesn't mean anything after that, really. For the functionality, par value stock can be sold at any price the market will bear, except at its initial issuance. You should know what treasury stock is. Sometimes the corporation retains a certain amount of shares it hasn't sold at all, or they buy back shares to strengthen the company's value system. They might buy back. That's called treasury stock. It's owned by the corporation. It doesn't pay any dividends, and it doesn't have any voting power. Watered stock is sometimes stock is issued to somebody for real estate. For that real estate, we'll give you $100,000 in stock, but the property is only worth $40,000. That stock is deemed watered down. If there's any losses or liabilities, the watered down stock will be treated like that through a court action. You have to prove it. Sometimes it's not that easy to prove, because sometimes watered down stock is given in exchange for patent rights or intellectual property, and it's very difficult for the court to determine the actual value of it. And again, transfer of stock, if it's publicly traded, that's easy. Just put it in the market, it's sold. If it's a closely held corporation, the stock certificate can limit how and under what circumstances that stock can be sold. I had family, not me directly, but in-laws, that owned a corporation that was closely held, and every so often some of the family members would want to sell some of the shares of stock, and they couldn't because they had to sell it to the corporation first, and only under the rules upon which there was enough reserve capital to buy those shares. So it was often held in chains, for lack of a better way of saying it. The family would often argue over that, that were inheritors of this stock, that they wanted to cash out. They didn't always have the ability to do that. So a shareholder typically transfers stock by endorsing the stock and delivering it to the buyer. The buyer should have the corporation issue a new certificate. Told you that before. And again, there isn't always a right to sell or exchange outside of the corporate family, because they want to do business with in a small corporation. Maybe want to keep it limited to those who are, but outside that, you can't restrict it too much, or it becomes almost lacking in value. Stock options, very important tool. Say they want to hire, they think I'm a real talented guy at some company or something like that, but they don't have a lot of cash to pay me. They might induce me to come and says, we think you can make our corporation work much better, Jim. We're willing to pay a kind of a reduced salary. You're going to make $50,000 a year, but you're going to have a right to buy our shares of stock at $10 a share, but you'll have that right for the next 3 years. Well, when I come into the company, what if the shares of stock are worth $10? Well, if I buy them in the day I come in, I'm not going to make any profit on it. So, but having the power to buy them for $10 a share 3 years, the goal is, if I'm the new president of the company that was hired, that stock option might motivate me to do a really good job. Because if that stock now goes up to $15 a share after the 3rd year, now I can buy it for $10 a share. I'm guaranteed a $5 profit. And the other incentive is that $5 profit might be taxed at a lower rate than traditional income is taxed. Capital gains is often taxed lower than traditional income tax. And so there's the other incentive with stock options. So sometimes people get into the option trading because they have the right to buy at a certain price. Now, what happens if it goes down? I had the right to buy at $10 a share, and now 3 years from now it's worth $8. I'm not going to buy it. I'm going to buy a loss. It's sort of a risk. I think of stocks, in a sense, does have some gambling aspect to it, but there's an incentive when you're running the company or have an interest in promoting the company to make the company do well, because then you might be able to make a huge windfall through the stock options. Dividends, not every corporation issues dividends. Some are growth stocks, not dividend paying. And generally, dividends come from profits to the shareholders, maybe paid in cash. Property usually is paid in cash, or stocks in another corporation that corporation owns, the parent corporation. And it can't be rescinded once it's ordered, and you can't usually demand that stocks be given a dividend, even though there's a profitable year, because they want to reinvest potentially. I'm just looking at this. Now we know the blue sky laws. These all came about to really protect the consumer and to protect the entire integrity of the the economy, because we know what happened in 1929 with the stock market crash. And so in 1933, that's the initial issue. And so stock securities, called the Security Act of 1933, and then the Security Exchange Act of 1934, that's the resale of securities of stocks later on. Both came about right after the Great Depression and FDR's administration, trying to put some integrity in the stock market, that they have to have perspectives, they have to show the nature of the financial stability. There's no insider trading. So if I'm working for the corporation and I say, I know we're about to get this big government contract to supply certain things for the military, we're going to make $1 billion in profit. What can I go out and do tomorrow? Buy a bunch of shares of the corporation because I have insider trading information, and that hurts the consumer. It hurts the stock market's integrity. And so those kinds of things are banned, insider trading. Or the other way, I know we're going to lose a ton of money down the road. Our stock is valued at $20 a share, but I know we're going to get dinged on some contract that we've had in the past or some liability that's going to come up. I'm going to short sell. I'm going to sell today and then reinvest later on. That's illegal as well. And this kind of perspective also gives the ability of potential buyers of the stock to know the financial stability of the company, how many people own it, who's running it, how many shareholders there are. Things of that nature are very, very important. In the first chairperson of the Securities Exchange Commission, Joseph P. Kennedy, the President John F. Kennedy's father. And there's an old saying, well, why would you give it to him? He goes, well, if anybody knew how to make money in stocks and knew what needed to be controlled and protected in terms of future stability, it would be him. And actually, I think he did a very good job. When you look at his history as the director of the Securities and Exchange Commission, probably did pretty darn good. And we know that we're trying to keep some basically anti-fraud provisions going on in the scope of the law. Regulates the sale and resale of securities and interstate, two or more. Almost everything impacts interstate commerce. So most sales of securities are controlled by the Securities and Exchange Commission in terms of legitimacy. The Security Protection Act of 1970. This is the Securities Investors Protection Corporation. They hold funds for people who have been basically ripped off by fraudulent activity of different corporate leaders. Bernie Madoff, that might ring a bell to some of you. A lot of people say, oh my God, all these people lost all of their money. Many of the people got money back through the 1970s. I never can remember the specific name of it. The Securities Protection Act of 1970 had a pooling of assets for people who were injured by fraudulent activity in the stock market, and that was done there. But just as a quick recap, what is the ownership of a corporation? The shareholders. Shareholders become owners of a corporation by their initial subscription to the corporation or by purchase on the secondary market by resale. Initially, you have to pay par value, but later on, you can pay whatever the market's willing to bear for that share, unless it's a closely held corporation, which limits the ability to transfer the stock. It can be traded freely in the market. We know there's different kinds of stock. Most common shares. They have the power to vote in the board of directors, and they get shares of profits through dividends if the corporation issues dividends. Otherwise, it's just a growth stock. And we know there is something called preferred and preferred cumulative and non-participating. Preferred gets in line first. If there's a profit, they get their cut before it's distributed to the common shares. If it's cumulative, we know that in a year that doesn't have a profit, they get nothing like everybody else. But in the following year, when profits are issued, they get the previous year that was not guaranteed, but claimed 5% and the current year before any common shares get their share. It can be a very, very attractive way to invest. However, you usually pay a lot more money for preferred shares of stock. But what else do? You also limit your rights to vote for the board of directors. You lose the little bit of control that you would have if you were a common shareholder. I went through that very fast, but the book is very clear, and there's some other videos I think that were put up on Blackboard, I hope, helping describe some of these concepts. And for purposes of a practical application for smaller businesses, I think the limited liability company is taking a lot of the steam out of the attractiveness of corporation. Because again, what's attractiveness of corporation? Raising funds and limiting liability. You can do those things with an LLC with more ease of an organization, and the tax election of an LLC is a little bit simpler than there is in a corporation. I'll leave you with those thoughts. Just a brief summary. Hope everyone is well.